This is the Daily Market Rundown live from the Tradelo trading floor. It's August the 8th. Some highlights from today's show. Trump nominates an Uber dove to the Fed. Gold Comex gets hit with tariffs. And the BOE announces a hawkish cut. Happy Friday and welcome to the final trading day of the week. Having a look across, of course, the board. It's a pretty quiet session, which is to be expected given we have seen risk markets really have a very decent sort of low volume week to the upside. There is, of course, a lot of headline news to cover, as is the case. That's been all year. So let's get stuck into it. And our first topic is very much about Trump announcing his pick to replace Kugler on the Fed. Now, Kugler is a voting member until, of course, January next year, which means the pick Miran, effectively that has come via Trump, will only effectively have 4 meetings in which he can vote, and then of course gets replaced. There's a key takeaway here though. Miran is of course been very vocal about the Fed, being very sort of vocal about how the Fed ultimately makes decisions on outdated data, not forward-looking data, and he's been very adamant about a bit more governmental role in determining what the Fed can and cannot do. And so I think it's an interesting pick. I think the key takeaway from it is that there is a general line of thinking that Miran will now join some of the other doves, definitely on the board, but he may even join as an Uber dove. What's an Uber dove? Well, it's the one that ultimately not just dissents, but starts talking about 50 basis point rate cuts. And that's very much why the markets have had a little bit of a move on this appointee. Now, whether or not he gets a 50 basis point cut is another story. Of course, there are a lot of members to convince, but this is the key takeaway from it. Miran will be voting only for cuts. We've got 3 more meetings this year. And of course, we do know that September is now pretty much baked in 100% chance of a 25 basis point cut. So don't be surprised to see him come out very vocal. And of course, there are a number of other members that have been very vocal. And I think it's a good sort of point to look at who is now dovish and where and how could a 50 basis points cut come about. Now, we know, of course, and I've underlined them for you in the red, are our members now that are dovish. They're openly dovish, and they are effectively guaranteed to vote for a cut of some magnitude in September. So that'll be Waller, Bowman, Goolsbee, and then Daly, and of course Kugler is now being replaced by Miran. Now, that's 5 of the 12, which means pretty much we've got almost 50% voting for a cut in September, hence why the market thinks 100% chance of a cut in September. But what opens the door to 50? Well, look, we must never forget that Jefferson, Powell, and Williams maintain the center. They are, of course, the key sort of bigwigs on the board. They typically vote in tandem together. And in order to get a 50 basis point cut, you're going to need to get them on board. Okay, that is the key sort of takeaway. Generally, consensus will be formed around the chairman. So if the chairman's not in any mood for 50 basis point cut, it doesn't matter how much Miran wants a 50 basis point cut, he ain't getting it. Okay, it is still a majority rule, but what it does mean is very, very likely at the next meeting in September is we're going to see a lot more dissent. Okay, we may even see a case where we get a cut and we get dissent. Okay, and if that's the case, if we get a cut and we get a lot of dissent, what that suddenly starts to do is it starts to open a debate towards why we're not getting more aggressive cuts than 25. Now, don't forget Jackson Hole is coming up in just over 2 weeks. It is typically, I think it's the 22nd of August, so it's the end of the month. And that's the chance for Powell to set the tone, to perhaps open the door to, of course, that September cut. Now, don't forget last year, August, was when he opened the door to not just 25 basis point cuts, but actually the first 50 basis point cut. So just keep an eye on it. I think that's the key takeaway. Miran is very much an Uber dove, and he's been placed there for a very good reason, which is get those damn interest rates down. Now, moving on, of course, just looking at some of the polling odds in terms of the Fed chair. We know that, of course, whoever gets picked to the Fed chair is going to be dovish. Okay, it's very much it's an unusual situation to say that the next Fed chair will be dovish regardless of what inflation is doing. But that seems to be the case, and of course, we know that Chris Waller was the first one to put up his hand a couple of weeks ago when he turned dovish, and he was very critical about the Fed being late, and ultimately he did dissent at the previous meeting. So we know Chris Waller is now currently in the lead, and of course we can see that Kevin Hassett, as of yesterday, was effectively the leader, but we can see now the market's starting to favor Waller. Now the difference between the two, I think the way to think about this, whether it's Waller, whether it's Hassett, I think Waller is perhaps a little bit more of a continuation pick. What do I mean by that? Well, look, he's been on the Fed for some time. He's been a voter for some time, which means if he becomes the chairman, sure, he is dovish, but he's dovish because he thinks his forward-looking models point to inflation slowing. Okay, so just keep that in mind. Chris Waller will be more of a continuation move, whereas Kevin Hassett might be considered more of a political appointee. Okay, the way to think about it: if Waller gets in, fine, he will be dovish, but he's already dovish. If Hassett gets in, I suspect there may be a little bit more of an uber dove as the chairman, and that should have implications for dollars, for the dollar, and of course long bonds. Okay, keep an eye on that. Of course, that is very much in the moving. And then interestingly, I don't know how much you want to take from this. I would take this with a huge pinch of salt. The odds of a Fed chair pick by the end of the year is only 50-50. Whether that's right or not, I don't know. I would suspect that it's going to come down to ultimately what the Fed does in September. I suspect if we do not get that first cut, we may find a bit of impatience from the president, at which point he says, I've had enough, I'm putting that shadow Fed chair in place so that we can get things moving on. All right, then let's talk about gold. Obviously it's topical, and we have seen a gold futures hit a record high. That's the Comex futures as a result of a 39% tariff imposed on gold bars. Now, again, the way to think about this, when I initially read this, I was trying to just work backwards as to what the second and third order derivative is as a result of this. Now, obviously, the first implication is that Comex gold will trade at a premium to London, to LME gold effectively, because ultimately they need to pay a 39% tariff. Okay, I think that's the first thing to take away, is there's going to be a spread, and we'll get that chart up in a minute. But I think the other way to look at this is, what is the opportunity scope for us as traders? Okay, this obviously came out around midnight London time, so we were all hopefully asleep. But the real play now is, I suspect, we've got to ask ourselves, why has this happened? What's the move here? Now, we know that, of course, Switzerland has been in the spotlight all of this week. We know that they are stuck with a very, very high tariff, and that, of course, the president of Switzerland went to Washington in hope of getting some sort of reprieve, and she got nothing. She got kicked out the door, basically. And so I think the key takeaway here is, where is the play? Well, I think we might hear something over the weekend where we see some concession coming from Switzerland. We know they can't afford a 39% or the tariffs they have. And of course, this feels like perhaps a little bit of a swipe at their smelting industry. I mean, at face value, this is probably costing them somewhere between 5 and 10 billion. So it's not like economic, catastrophe for Switzerland. Sure, it's costing them a couple of billion, but it's not a catastrophe. It's perhaps one of their smelters that goes out of business. But again, this seems very political. It seems very much geared towards forcing the hand of Switzerland into concessions. And so I think the real play here is actually some form of a spread, a play effectively where you're trying to sell Comex versus buying spot or buying gold for delivery in London. Now, most of us cannot do that, unfortunately, unless you've got a wonderful prime broker that has access to these sorts of things. It's not really a play I can understand how we trade, but I think where we have got an opportunity is structurally. We'll look at the gold chart in a minute, but I think selling Comex ultimately
one time framing sell.
Should we see some positive news around Switzerland? I think that is the play today. We can see, of course, the spot price is down 0.3 on the day, and we can see that the futures have given up a large part of that spike. So the real play is when we see Switzerland coming to the table, when we see the Swiss offering up something, I suspect you'll probably see Comex sell off as a result of that, because ultimately that spread needs to unwind. Okay, what do I mean by that spread? Well, let's see the chart. Well, this is the futures first. Interestingly, the news hit the market via the FT there, but we can of course see someone else had that news prior to it. I mean, we rallied about $40 even before the news hit the Financial Times. So there you have it. These things seem to be choreographed to a select few, and we can confirm that with the volumes as well. Okay, quite a significant pickup at volume around sort of late night, and then of course the announcement comes out. As I said, most of that move has retraced itself, and that's two things I suspect. One, there is this general thinking that again it's probably more political and something that will resolve itself, similar to what we had with copper, and so I think a few people are a little bit shy in a sense, or they're looking at this saying, well, there's no need for that spread to blow out because we are perhaps going to see some sort of a deal in the coming days. Okay, there is that spread. And what we can see is obviously the spread of Comex to London price is ultimately $64. I suspect the play is to sell Comex and buy London gold. I suspect that's the play, that's the free money. But like I said, not something us normal people can do. Perhaps something you can do if you're at a bank or an institutional outfit. Okay, and then talking about the gold price, we spoke about this yesterday. I think this was our key play, was looking for that short side trade. Of course, the Fed pick, the Ubadav Miran didn't solve that problem for us, and the overnight Comex news doesn't really kind of put that offer into gold yet. But like I said, I think we perhaps get some news over the weekend regarding Switzerland and regarding concessions from Switzerland. And I think when that comes, I think that play happens. Okay, I think we are now structurally looking very, very juicy to the downside. It just needs a little bit of time. Okay, I suspect that play comes in perhaps over the weekend, perhaps early next week. So keep an eye on gold. There are also now a lot of stale longs in the market, aggressive longs that perhaps joined or got forced to buy it on that Comex news. So just keep an eye on it. It really does feel like a market that is going to offer a really decent downside move in the near term. Okay, and then in terms of the auction yesterday, just to cover that, I think there was an interesting takeaway there. And I think the key takeaway from that is, sure, we did have a decent tail, which is the first in some time. At face value, you would have looked at that as a trader and gone, wow, they tailed on the 30-year, that's really problematic. Well, sure, it's problematic to have a 2 basis point tail if we had offered, 4.9% high yield. In other words, if the US government had tried to offload 30-year bonds at the highest yield in 5 years and they had a massive tail, yes, that would be concerning, because what it tells us is that investors are not willing to accept the highest yield in 5 years. They want even more. Okay, that would have been concerning. I think the reality was the high yield came in at 481, so it was almost 8 basis points lower than the last auction, and as a result of that, perhaps investors are saying, hang on a sec, fine, yields may have paired off a little bit on the 30-year, but we still want that high yield because we still think it's justified given all the, of course, political concerns going on in the US. Okay, so I think you kind of had to put that into context. It wasn't something I thought about when the news hit. I was quite adamant that, a 2 basis point tail was problematic. But again, contextually, I think you need to remember that the high yield came in at 481. Okay, so what we want to look out for that next auction, if the high yield did come out at 489, which would be the highest in 5 years, and we had a big tail, that will tell us a lot about investor appetite when yields are, of course, at record highs. Okay, in terms of the bid to cover, I think it's the same thing. I mean, bid to cover came in somewhere around there, 2.27, which is the lowest, of course, in a number of years. But again, it's because of that high yield. In other words, the yield just wasn't high enough to justify a really, really dominant bid to cover. Okay, had that high yield been 485, 486, I suspect that bid to cover would have been higher. And so it is. It speaks volumes ultimately what people think. People don't want lower yields. Okay, and so I suspect going forward, should we see high yields come in again below 480, I suspect bid to covers will be weak, and of course we will of course see big tails. But ultimately, that's not really going to spook the market. Okay, what spooks the market? High yield is high, no bid to cover at high yields, and of course big tails at high yields. Okay. And then moving on, of course, talking about high yields, we might as well continue that conversation because I think the high yield chart's very interesting. This is a weekly chart of the high yield ETF, and what it's telling us, and again, if you kind of try and map the S&P on this, okay, so you go back to, of course, the tariff plunge, we can see that the high yield is pretty much just back to where it was when it started the year. Okay, moreover, I mean, don't forget, 2022, of course, that's when we had the big plunge, the big correction in high yield and of course equities, and high yield has never really recovered from that. Okay, if anything, if I'm going to connect those dots for you, you can see we are in very much a funneling process where high yield has just not quite recovered. Now again, if you're going to see some form of a recession, you are going to see it in the high yield. It's going to be a very good leading indicator, and again, I just think for the last 4 or 5 weeks, the fact that high yield is not really taken part in the equity rally just speaks about the general nervousness around what's going on in the stock markets. Okay, in other words, the stock markets are really just running on speculation. Okay, there's nothing from an economic fundamental perspective that's driving this. If there was, high yield would not be sitting well below, of course, the levels from 2022, and we would have very much exceeded the levels made back in September 2024. Okay, so this is the key takeaway. High yield is telling us that there are still very much economic problems in the US. They have not gone away, and the stock market is just simply its own beast. Okay, it doesn't mean that the stock market rally fades. It doesn't mean anything. It just means that high yield is telling us that the move in equities to record highs is on borrowed time. I think that's the key takeaway from it. Okay. And in terms of gilts, I think the BOE was an interesting one yesterday. Reading through the transcripts, they had to do a revote, and the BOE is stuck. I mean, they've got a very problematic situation in which they're forecasting 4% inflation this year, and they actually cut rates yesterday. So that tells us everything, which is they are prioritizing the economy and, of course, the employment part of their mandate. But the reality is that the fact that they're cutting means, and they have inflation of 4%, means that the next cut, there's just a very, very tall bar for that. Don't forget they had, of course, a split vote, which is very, very unusual. And what that suggests is, fine, they may have cut yesterday, but more cuts this year may not actually materialize. Okay, so initially I think the pound went bid. I'm not sure that's the right play. I don't understand why anyone wants to own the pound or gilts for that matter. And that's why we've got this chart. I think what we are likely to see at some point towards the end of this year, we are going to start seeing these gilt markets move up. Why? Well, look, if you're cutting and inflation is starting to re-accelerate, we do, of course, expect investors to demand higher yields. Okay, we can see it's been very contained. Yields have been doing nothing ultimately for the last couple of months, but keep an eye on that. Okay, I think gilts is an interesting one. It has been a leader of sort of G10 bonds in the past. So it is one we just keep an eye on. Okay, not really tradable at this point, not something we're looking to do anything, but we get beyond that 470. I do suspect gilts are going to be dragging the likes of the German bonds and the US bonds with it. Okay. And then, of course, our play of the day, it's again the gold market. Okay, we can see structurally we've got these lows. I pointed it out yesterday. The play yesterday was to look for a break below that overnight low. It never materialized. We did, of course, end up closing on the high of the day, and then we had that overnight spike. So again, it's a repeat of today. I think for today, the close is going to matter. I don't think that we get the aggressive sell-off today unless, of course, like I said, we get some positive Swiss news. But I think the close is going to tell you everything today. I have a suspicion we are going to close a relatively weak given the overnight move, so some sort of a key auction reversal. And what that does mean is it opens the door to a Sunday night play / Monday play where we do get that washout trade. Okay, so very much if we do close anywhere around that 34.50, it's going to signal quite a lot of weakness, perhaps a blow off top. Don't forget we are very much in a consolidation pattern in the gold market. And so should we close below 34.50 or around that 34.50, it really does point to a weak close. And then I do suspect Monday, not only do we take out the Friday lows, but we take out all of the lows of the past week. Okay, and that is our play of today should we get positive news, as well as, of course, moving in to the weekend. Okay, that's a wrap then for today. If there are questions, do post them in the Discord channel. Otherwise, it is a Friday. No need to be aggressive. It is summer. Make sure you take advantage of that. We will have, of course, quite a number of things to do towards the end of the month. And of course, once Labor Day clears on the 4th of September, we are back to full-time trading. Otherwise, good luck out there. Manage the risk. Go make some money.